Welcome, everyone, to the post wrap-up of ACT Research's Seminar 70. I'm here with David Spencer, VP of Market Intelligence for Arrive Logistics. My name is Tim Denoyer. I'm a VP and Senior Analyst at ACT Research. David, tell us a little bit about yourself and Arrive.
Yeah, sure. My name is David Spencer. I'm the Vice President of Market Intelligence at Arrive Logistics. Arrive Logistics, by the way, is a top 7 truckload brokerage here. We operate mainly in North America, over-the-road service transportation. One of the things that we're hoping to do is get into the top 5 brokerage over the next 12 months or so through sustained organic growth. And my role is largely focused on what's going on in the freight market and what are the supply and demand trends that are driving that, and then communicating those findings with internally with our leadership and externally with the partners we work with.
We've just come off of a really great couple of days of meetings with a wide variety of people in the trucking industry. I'm very interested to hear your takeaways as a first-time attendee, so welcome.
Thank you. Thank you very much. I found the seminar to be really informative. I think there's not a lot of content on the supply side and what's driving the decisions that are being made around the supply side. So for me, it's a deeper dive into an area where we don't have a lot of visibility.
Great. Let's jump into the first kind of key topic of the seminar. Of course, we want to know what's going on in the freight markets. We had some great CEOs from truckload fleets talking. I thought the commentary was generally encouraging. It's February. It's hard to get a great sense, but there was a lot of green shoots. The word green shoots maybe is being overused in general, but what did you hear?
Yeah, I mean, I hear a lot of talk around bottoming of where we're at in the cycle and where we're at in not just for the freight market, but also for equipment manufacturing as well. Sort of an up from here mentality, and I think that was confirmed, right? I think you're looking at carriers, as you mentioned, commenting on their operating costs, the cost of labor, costs of maintenance, the difficulty finding quality mechanics and technicians. All of those things should support upward rate movements, just in addition to the supply and demand trends we're seeing in the industry.
Yeah, definitely. Definitely. Costs are definitely a major issue. We hear that over and over again. The one cost area we saw some progress on was fuel. Fuel efficiency is getting a bit better, but every other line item is up for these fleets. What I will say, very encouraging commentary from a couple of the fleet CEOs on freight mix. Now, they're not getting higher rates yet, but they're able to choose a little bit more, and that's different. That's a change in the market that I think was really important to hear. It's probably a leading indicator of better freight market conditions in the next few months, and so that's really key. The fact that they're able to pick a little bit better freight and lean into some better mix, I think that's key. It's still very early, but I think that's a good leading indicator.
Yeah, and certainly one of the other leading indicators is the market's sensitivity to disruptions, right? I think. So coming into February, we've seen rapid rate decline, but that decline was for a reason from elevated rates from a weather disruption, which we really haven't seen to that degree in 2 years.
Yeah. The spot rates have beaten our expectations by a little bit so far this year because of that weather, for sure. And I thought one of the other demand takeaways from a volume perspective was our specialty carrier who said bulk chemical demand is picking up here in February. Yeah. And we like to look at that as an input to production and suggest that the industrial economy is going to pick up here this year.
The question I would have, for you and what your opinion is okay. So we saw some volatility in January from a spot rate perspective. How does that give us insight on what to think about for the remainder of this year?
That's a great question. I think weather's impactful, but it's also somewhat temporary, and that impacts is non-zero, right? It pushes upwards on rates, but certainly as you mentioned in February here, we're giving back a lot of that rate increase, but I don't think we'll give all of it back, and I think it puts shippers a little bit behind. Just from a January manufacturing perspective, we learned that some of the truck manufacturers had a tough time and had some down days because of the cold weather, and I think that suggests that there's some catch up to do in the rest of Q1. I think generally shippers, that can help volume trends.
Yeah, and when do you think would be the next test in the freight market here as to where we're at?
Well, the end of Q1 is always a little bit of an increase in freight volumes. There's usually an end of Q1 push in March, but with the timing of Chinese New Year this year being a few weeks later than last year, it's really going to. I wouldn't expect much this March. I think the litmus test is May. Mid-May road check is always really that kickoff. I think we'll be in a different market balance. I think one of the key takeaways from the data recently, but also hearing from our fleets and manufacturers is we're getting close to balance, but we're not quite there. And I think by mid-May, that's going to be a really important proof point.
Yeah, we're absolutely in the same camp. We think that's going to be the first test of where things are at, and certainly between now and then, not a ton of reason to think that we're going to see much change. Probably, similar rate environment.
Yep. Another takeaway from the fleets, they're getting into bids right now, and at the moment they're still a little bit on the defensive. Was the message that they gave us, and I love the candidness, but basically the shippers are still asking for more rate reductions. So that's where we are, and that's just important baseline.
Yeah, the fleet's sort of saying shippers are trying to take one last bite of the apple. That was the phrase that they were using on stage, and I think that this is something that we see through cycle to cycle is sort of this common behavior on both sides of the equation for sure. But shippers pushing down rates, I mean, a lot of ways that can contribute to rates going back up.
Absolutely. I think if nothing else, it just reinforces this capacity exodus that's already going on. Yeah. I want to ask you about rate APIs. We had a discussion about this. It's a bit of a topic that some people understand really well. Others don't fully understand it right now. One of the CEOs of one of the truckload fleets talked about it, and I think it's a very interesting dynamic right now. It's sort of a gray area between spot and contract. What do you think that means for visibility and the load to truck ratio going forward?
Yeah, well, I mean, looking at the spot market in particular, you've seen spot demand starve mainly from the attractiveness of contract freight, but also because you're seeing these shippers look at how to fit these rate APIs into their routing guide, right? And so they're getting contract style service with spot style pricing, sort of in that live environment, and it's offering them savings right now as spot rates are really low. And so it's kind of hard to pinpoint exactly how much of that declining spot, demand. You look at DAT load postings or something like that, and is it attributable to a market slowdown versus attributable to volume starting to go in the direction of rate APIs? And certainly it favors a larger carrier. You're seeing that, the smaller fleets, smaller owner operators, they're not going to have the ability to sort of integrate with these shippers in a way that has rate APIs. So it favors the larger carriers right now in this marketplace. So
yeah, definitely a consolidation phase in the cycle. Yeah. One other point I wanted to hit was intermodal, and actually this has a segue to a couple of points. We had, some intermodal discussion. We had a chassis manufacturer. We didn't have too much direct exposure to intermodal at this seminar, but I think what's happening on the intermodal network is really interesting. And I think the bigger point that I'm going to reinforce, it's somewhat related, is this private fleet versus for-hire market shift. So this has been a big shift this past year. There's been some insourcing into private fleets out of the for-hire market. Intermodal is sort of the leading indicator of this next freight cycle, right? So the big question is it going to be private fleets or for hire? Now, again, not at this seminar, but there was just news today, fortunately, that J.B. Hunt has acquired Walmart's intermodal fleet, something like 10,000 containers. Like, this is a significant deal. And what we've been seeing, again, that sort of prolonged the downturn, is this shift of assets towards private fleets, right? Now, this is one deal, but this moves assets back into the for-hire market. And I think it's a very significant change in what's been happening in the industry. And I think it's a very big public thing, which is just sort of fascinating at the moment. Curious as to what you think.
Yeah, well, I might throw it back at you and just ask what drove the push to private fleets, and why might we be seeing that shift back to away from that?
Well, great question. It probably worth spending a minute just kind of, rehashing, just the past few years is all of the supply chain disruptions, which we are seeing again, and there's certainly that's one of our, I guess, main risk factors this year is if this need for supply chain resilience continues, that's going to drive more investment in owning your own private fleet. Problem with private fleets is they're inherently much higher costs because you really can't fill the back hauls most of the time. Driver pays a good bit more. There's just a number of inefficiencies that make for hire generally more efficient, but and much lower costs. So I think the cost economics are gonna start pulling freight back into the for hire market. That's one of the parts of the thesis this year.
Yeah.
But it very much depends on what happens from those private fleets in their investment decisions.
Yeah. Well, I guess our stance is that any investment in private fleet is going to pull away from the opportunity for the for hire market. Should we see a flip? I think it could limit what that spot demand increase looks like if there is sort of a disruption in terms of routing guides that creates a traditional upcycle or inflationary market. That expansion in private fleet may limit the height of how high we see rates go and potentially the duration. So, that's sort of our perspective on what influence that could have. But just kind of touching back on what you mentioned with the leading indicator with rail or intermodal, are we seeing any kind of major shift? One of the things we talked about over the last 2 days was the shift back to West Coast in terms of imports and what's happening with global trade and the risks and what that could drive. So curious as to what impact do you think that shift back to the West Coast might have, on over the freight market?
Yeah, it's a great question. I think it's a perfect setup for this next few months, right?
Yeah.
It's a great leading indicator. We think a restock is just beginning. We think the consumer is generally pretty healthy. One of the key takeaways from our economic discussion this morning was just that the U.S. economy is surprisingly strong. We're setting up for 2.5% plus growth this year. And that's surprisingly not hard to say because we're coming in with so much momentum from last year. So it's the economy is just doing very well. So that requires a restock. We're not feeling it in the trucking market yet because capacity has been available, but we are seeing it in intermodal. We are seeing the imports coming to the West Coast. They're up 20% year over year for the last 5 months in Southern California. And East Coast is going to be soft. We know that, but this is just the beginning of the wave, if you will. And I think we're going to have some choppiness in the short term, partly because of the disruptions around the Red Sea, partly because of Chinese New Year kind of stuff. But as we look at the next 3 to 6 months, I think we're going to see those imports continue to rise. And at some point, the rail network's not going to be able to handle it, and then it'll end up on the highways.
So in theory, California or Southern California could be a starting point. If we start to see that demand pick up and tighten, that could be a canary in the coal mine, kind of. We're right on the verge of seeing things break.
I mean, it was in 2020, wasn't it?
Right.
I'm not expecting a 2021, 2022 type of a cycle, but because this is very different from that. But that has happened before. Like we said, there's certainly some risk that this upturn gets pushed out a little bit more. It wouldn't shock me too much. But what I would say is that over the next year, I think we should see a considerable upcycle. Now, is it going to be of the magnitude that we saw during the pandemic? I don't think so. But I think we'll see something in the neighborhood of 20% increases by the end of this year on a year-over-year basis. That's what's in our forecast. Again, some of the replacement commentary from the manufacturers, from the fleets who suggest that they still have a lot to replace. They're under a lot of financial pressure, but that's the kind of struggle that's going on, and that's what could push that number up or down a little bit. Is how that plays out. But we feel pretty good about this turn in the cycle, especially based on the strength of the U.S. economy.
So continued strength in demand, shrinking supply side, better balance, moving towards equilibrium. You think we cross that threshold and move into inflation in a significant way this year?
Yeah.
That's without some type of disruptive event.
Right. We think the disruption essentially is the capacity contraction that's going on.
Yeah.
There's a very strong inverse relationship between capacity and freight rates, and we've been taking out capacity from an operating authority's perspective for quite some time, but we've been sort of backfilling that, if you will, on private fleet growth. And so that balance is changing at the moment. And I think that's really the catalyst for higher rates.
Yeah. Yeah, our perspective is really similar and really aligned, and I think a lot of that is we're looking at the same stuff. But our perspective on demand in the industry is that we're going to continue to see flat to slight increase in growth in overall shipments and contraction in supply side, and that should fuel rate increases throughout the year. Our forecast is somewhere around 15%. So, like I said, very much in the range that you guys are talking about, and without any kind of disruptive events. So not looking at necessarily disruptive routing guides to the tune of 20-25% tender rejection rates, but certainly upward movement in rates as a result of all the potential green shoots we mentioned.
Now, one of the keys to this, the ACT Research seminar is always getting the OEM's perspective. And I thought one of the most important takeaways as we think about the freight markets from some of the manufacturers that we heard from was that tractor demand for sleepers in particular is coming down, normalizing off of record levels from last year. And that's really key to that supply dynamic changing.
Yeah, I mean, one of the things I was hearing is that this trucking recession has had a big impact on fleet's ability or desire to continue to invest in tractor growth. And, it's taking a toll, right? We saw strong demand, presumably as a result of backlogs and the time it took to get equipment. One of the key themes I heard here were, fleets talking about letting the average age of their equipment increase. A lot of that was a result of the dynamic that they were in, but not necessarily having the profitability to continue to invest in the fleets is something that could help limit supply growth and create a vulnerability as we look at supply and demand balance.
Absolutely. And that's really the crux of why this industry is cyclical almost, is every time we get to this point in the cycle, it forces that reduction in supply, just regular financial economics.
Yeah.
It actually sort of segues well into that regulatory question, which is on everybody's mind in the manufacturing sector. I think most people in the freight markets may not be top of mind at the moment, so I'll spend a second just kind of explaining what I mean. There's a bunch of regulations coming at us, and I want to come back to speed limiters, so remind me about that. But the big ones from the manufacturer's perspective are the low NOx regulations and the GHG3 regulations. We've spent a lot of time on this at the seminar. Low NOx in particular in 2027 is likely to raise the Class 8 tractor sleeper price very significantly, something around 15%. And that's not a cheap piece of equipment. And so those price increases are likely to drive a pre-buy in 2025 and 2026. And there's a lot of concern about sort of that transition to the new technology. And the reason that's important to understand from a freight market perspective, as you're thinking about that medium-term outlook, that's likely to keep this market very cyclical.
Yeah. Certainly, it would take some type of upcycle here to facilitate these fleets having the ability and desire to continue to invest in that equipment. For me, on that conversation, it was the zero emission vehicles, which, there's a ton of interest and excitement about, but also a lot of discussion about the real challenges that exist with being able to execute that. Mm-hmm. That was one of the main takeaways for me was, you have all these manufacturers and carriers here saying, we want this, we want to move in this direction, but the feasibility of that is something that seems not necessarily in reach in that kind of timeline.
Yeah, the total cost of ownership comparison between zero emission vehicles and diesel vehicles, it's always been the hardest in the Class 8 tractor market. And I will say, I think there's a lot of good progress going on in a lot of different vehicle types in the commercial vehicle space.
Yes.
We're seeing great progress in school buses, medium duty, different kinds of local applications, but electrifying heavy duty trucking is very, very difficult. And it's going to be a discussion that we'll have for a long, long time, but it is coming. And some of these regulations are going to really push it a lot harder. It's later in the decade, but it's definitely coming. So, and we got some very good feedback as well. One final point on this is I thought the CEOs of truckload carriers that we spoke with have really put a lot of thought and energy into this, and they are, this new generation of leaders, I think, is going to very thoughtfully, not too aggressively. Nobody wants to be too aggressive with this because that can be very costly. But they were surprisingly very sharp about the new technologies.
Yeah, I mean, and they're aware of the major investment it would take to move into that area. And I think, as we think through, we spend a lot of time thinking about the near term and the short term and 1 year ahead outlook or 18-month ahead outlook. But as we're thinking about the things that are going to impact the industry over the next several years, this has the potential to be extremely inflationary and a major challenge.
Absolutely. I think, unfortunately, we have to go through a downturn, but then later in the decade, some of these regulations could cause one of the biggest upcycles ever, frankly, as we get to kind of 2030. These regulations, they're going to be very impactful.
What do you think what do you think is one of the bigger upside risks that we're not really talking about right now to the forecast?
Yeah, well, one of the rules that's being talked about in Congress that we heard about from one of our truckload CEOs that seems possible this summer, maybe, is a speed limiter regulation. Now, it's hard to know exactly how widespread. If it may just be on new trucks. It's hard to imagine retrofitting the fleet for speed limiters. But even if it just impacted new trucks, it would start to have an impact over time on capacity in a fairly considerable way. We've all, anyone who's been on the highways lately has seen trucks going pretty fast, and so a speed limiter rule is one of those things that could pinch capacity, and that would push rates up. Not in our base case, but an interesting thought.
Just off the cuff here, how do you think that type of impact would compare to something like the ELD mandate that went into effect? I feel like that's probably the most relevant example of something similar.
Yeah, that's a very good one. I think it could be similar. It doesn't seem like quite as much of a cliff event. It might be more gradual because, again, I'm not sure they would force everyone to retrofit. That seems like a big challenge. If they did, though, it would be very similar to an ELD.
Tim, obviously, you track a lot of things on a consistent basis. What do you think you're going to focus on between now and the next event that people should be looking forward to come to that next event to hear more about?
It's a great question. There's always lots of great data out there. I'd say the two things, they're sort of most on my mind right now. We've talked a bit about intermodal, so we'll be watching intermodal spot rates, especially off the West Coast, very closely. I think that's going to be a leading indicator for the truckload spot market, as I said. And then in terms of our cautious sort of view on is this really going to take shape? Of course, we're going to have to keep watching new truck orders. New truck orders have come down, but they've been maybe a little uncomfortably high for those in the for-hire market. And I think that's going to be a key indicator going forward and will help shape the next phase of the cycle.
Yeah, for me, I really think, the supply and demand trends, there's a lot of alignment around that, right? Stable demand, shrinking supply. But what I think is going to create vulnerability is that closing of the spot to contract rate gap. And so, I heard the carriers talking about it. I know that's something that we're in a lot of talks right now with shippers about, but there's a lot of open RFPs and bids right now. And I think that commentary around one last bite out of the apple, I think is really intriguing. Where are contract rates going to reset to here in the early Q2? How much are we going to see that gap close? That's something that I think is really critical to what will drive vulnerability to a more sustained disruption in the back half.
I think it's a great point.
Okay.
And how can people reach us?
How can people reach us? Well, for us, first and foremost, I think our website, ArriveLogistics.com. You can find all of our research, which features a lot of the great takeaways from Tim and the ACT Research team. That's probably the best place to find all of our stuff, but LinkedIn is another area we're very active. Where can people find you?
I appreciate that endorsement, and you can always find us at actresearch.net.